Market timing, the question I get asked all the time as a chartered wealth manager, and it will never get old, no matter how many times you say the saying, it's time in the market, not timing the market, that's important. I get asked the question time and time again from new investors specifically, or less experienced investors. So there's a lot going on in the world right now, right? There is global stock markets dropping back quite considerably, the same with a lot of other asset classes, and people are naturally concerned about portfolios, about investments, and I thought I'd drop a quick video just talking about those concerns. Just to be clear, this is no way financial advice of any kind, it's just one guy's opinion. Thankfully, this guy does have 15 plus years experience working in wealth management, was previously a stockbroker, and sadly I'm a bit of a geek and I did my masters in risk management, sadly a very, very long time ago now. But let's just cut straight to the core of it, right? So the stock markets have dropped back, just like a lot of other asset classes. This happens in near enough every single asset class. It happens in property, it happens with the commodities, it happens with crypto. Obviously, that's literally happened to crypto right now. Now, the thing to understand is near enough every asset class will always go through cycles, right, and have its ups and downs, and that is part and parcel of investing. If you invest in anything, stocks and shares, property, whatever it may be, crypto, this comes along with the journey, right? So you have to accept that. And the danger really only comes if you're forced to sell out of that asset at a time that is not particularly favourable, e.g. when the markets drop back, or when the property drops back, or when your crypto portfolio drops back, right? So what I'm going to do is focus more on stock markets because it's more relevant to more people. Now, since time began, literally stock markets have only gone up, right? Yes, they drop back, there's major events, whether we go back to the Great Depression, 100 plus years ago now, or we go back to the financial crisis more recently, or if we look at really recent, the pandemic, or when Russia entered Ukraine back in 2022, all those scenarios, all those events massively shocked markets and they dropped back. Sometimes they drop back greater than others, closer to 50, 60% in major market drops. Sometimes it's closer to 10, 20, 30%. It just depends on obviously the event specifically. But without fail, markets have continued to rise, right? They have always recovered. So the key thing to take away is, just like property, people say bricks and mortar, you can't go wrong, it always goes up. The same applies to stock markets. However, typically you will get a greater return on stocks and shares over the long term historically compared to property. You look at any major property indexes, you compare them to stock market indexes, and they have stock market indexes have significantly outperformed, especially if you take the top performing ones like the S&P 500. Now, just to be clear, that is not a recommendation to put your money in the S&P 500 because that is a gimmicky bit of advice that gets knocked around on social media platforms all the time. There is safer, better options to invest, in my opinion, but we won't go into that right now because I'm certainly not giving any form of investment advice. But the point of this video is that if you hold investments right now, if you hold a portfolio of stocks, shares, bonds, even people who are holding crypto portfolios, and that's got hammered as well recently, one thing to remember is obviously it's only a loss if you actually sell out of the portfolio. That is only a scenario if you put yourself in that position where you've invested money that you potentially need access to in the short term, and you should not have been in that position in the first place, especially, of course, if you're using a good wealth manager, a good financial advisor. So if your portfolio has dropped back at the minute, your pensions, your investments, whatever it may be, what do you do right now? Well, it's really simple. You don't do much, right? If you look at your stock portfolio and it is down 10, 20, 30%, that is naturally a discount from where it was, say, a month ago, right, before the whole situation in the Middle East kicked off. So if you were to invest more money right now, you are quite literally getting in at a discount, because you can see when you look at your portfolio, if it was up here about a month ago, it's now here, it's made that drop, there is a discount. You were going to get in at a better price. That cannot be disputed. Now, the interesting thing is, can the markets go down further? Are you capturing the bottom of the market? And my point around this is, it's irrelevant. It doesn't matter if you're capturing the bottom of the market, because no one can time markets. I do not care. I don't care what anyone says, any financial advisor, wealth manager, economist, I've sat down and been in webinars with the top economists for managers in the world during my 15 years of doing this, and no end of them consistently get it wrong. You cannot predict the future. There is way too many variables. So if you were to invest right now and say your portfolio is 10% down, one thing to note is that is a 10% discount. Now, if the markets go down 10% more and your money drops even further, that will at some point rebound. Now, it might rebound in another week, it might rebound in another month, it might even take a year for the portfolio to recover. But I think the key point is you don't need to capture the bottom. If you have already got in at some sort of discount, as long as you stay the course, as long as you remain invested, you are going to capture some growth off the back of what's happened at the minute. So the point I'm trying to make is you do not have to capture the market at the bottom. If there is a discount in the market, if the stocks and shares have dropped back, there's a correction because of a major event, the loss of confidence in the market, which is the main driver behind the market dropping back. Timing the market shouldn't be important. It should be the case of if you have surplus cash, it may be opportunistic to top up your investments, top up your portfolio. Now, if you can't do that, riding the market out is normally the best thing. As long as the portfolio is structured well, it's well diversified, especially if it's managed by a leading wealth management firm, you're going to be okay. The market's going to recover. It just means the portfolio has taken a hit in the short term, and emotionally, you've got to detach from that. The really interesting thing to see is if you can see your portfolio online or on an app, it becomes more real because you can literally see the value drop, right? But if your property dropped back 5-10%, you wouldn't bat an eyelid. And that's so true of most investors. If their main residence that they live in, drop back by 5-10%, that could be for some investors a 100k, 50k, whatever k drop. And they don't worry, they don't even bat an eyelid, right? Because they think, well, I'm living in it, it's going to have no effect on me. That is exactly the same with investment portfolios, assuming, of course, you don't need access to the capital in the short term. So my kind of guidance to everyone right now who are worrying about investments, pensions, or other asset classes is just stay the course, ride it out. As long as you have a well-diversified portfolio, you're not invested in just one stock or share, you have a load of positions all over the world in different industry sectors. That will give you the resilience you need to see this through. And if you have the ability to put more money in when the market's at a discount, it may, depending on your portfolio and who's advising you, be an opportunistic time. So what I would always do is flip this on its head. And this is one thing I teach my own clients, okay? Volatility is an investor's friend. If markets don't drop back, if there's not a lack of confidence in markets now and again, where there's an opportunity like this where stocks, shares, companies' valuations drop because confidence has dropped back in the markets, it doesn't present an opportunity to buy in at a lower price, right? A share price is just a perception of what a company is worth. And when confidence gets hit, like it has at the minute because of what's going on in the world, the share price will naturally drop back and it might get closer to what is the intrinsic value of a company, the true valuation of the company. That then gives you, as an investor, potentially a great entry point. So at the minute, there'll be loads of top fund managers all around the world that will be buying up opportunities at a much better price because there's been a lack of confidence in the market. And in the meantime, there's a lot of people who will be acting irrationally, that will be selling when they don't necessarily need to sell. And the top investors in the world will be buying up these opportunities at the right price and at the right time. So my key takeaway from this video is really simple. When the markets get rocked, when there's a massive correction in markets, don't let the emotional part of that affect you. Don't worry necessarily about your portfolio if it's being professionally managed or you have it well diversified. It will rebound, and now potentially may be a really good time to rebalance the portfolio, or better yet, it may be a good time to add further funds into the portfolio. Now, it's going to feel a bit unnatural. You're not going to want to throw money into something that looks like it's dropping back, but it is a opportunity that doesn't normally come around very often. So my best advice to you is always go and consult with a good advisor, a good wealth manager. Take professional advice because it will pay for itself, and they can help guide you in terms of how you should structure a portfolio during times like this, whether you should add further funds into the portfolio and so forth. So hopefully this video was useful, guys, and I think the underlying point here is just stay calm.